Algorithms and the Greek alphabet don't often fit into the average investor's lexicon. To investors like those of Emperor Asset Management, these are tools to be used in generating alpha through momentum strategies. To explain their methods, as well as some of their favorite picks, is Flynn Robson. Thanks very much for your time this afternoon.
Thank you, Ron.
Let's start with a little bit of colour around the fund and around your investment strategy.
Well, first of all, it's unique and transparent. That's very important to us. Second of all, as you know, we follow a momentum and a value strategy. So the momentum there is to create performance and, as you mentioned, alpha. The value side is to reduce risk. Basically what we do, we have an algorithm that goes out, picks the market strength, and we pick those stocks that are, if you will, we buy higher and sell even higher. That makes sense. So we look at those that are performing very well, like the likes of Mr. Price, and that's done well for us with 35% year to date. So we like the strategy. We've back tested it over a number of years, and we've been running it for about 8 years now. So it's worked for us, and it's something we're going to keep going.
Just in terms of that, Flynn, I mean, you know, many people are very familiar with the Warren Buffett school of investing, which is value-based. We've seen very successful investors like George Soros and Stanley Druckenmiller embark on momentum strategy. Just tell us the philosophical underpin to buying higher and receiving a share price that's buying higher and selling even higher. Well,
I think it boils down to one thing, Warren. I think you just buy performing stocks. So you go out there, you look for stocks that have really done really well, and there's more upside. I think a lot of people get out too soon. We've taken the fundamental side out of it, we've taken the gut feel out of it, and we've basically plugged into an algorithm the ability to tell us when to get out. That's not to say it's our only strategy. There's obviously a market timing part to it and all that. But for us, it's purely identify the stocks that are doing well, buy them, get in, hold them for maybe 1 to 3 years, and then when the time is right, get out.
Are the algorithms telling you to get out of industrial, specifically retail stocks right now?
No, actually, we've seen a pullback on the momentum side for sure. It's still in a green zone for us. We're still fully invested. For one reason is that we think that the market's pretty cheap at the moment still. We are watching it closely. There's a lot being said. There's a lot of noise.
Isn't there a tale of two halves in the market though? Do you really believe that retail stocks are still cheap?
No, but they still have momentum. So we have no reason to get out of them, should we say. And with the underpin of the value that's in the market at the moment, well below 18 for us, it's something we're going to watch daily, as I said, but it's something we're going to stay fully geared into at the moment.
Just in terms of that, I mean, when you say that you look at these algorithms, these are mathematical equations that are looking at technical aspects around a stock and not at the fundamentals. So I take it there's not many annual reports lying around your office.
No, they're too complicated for me, if you will. No, I like to remove the gut feel. Our whole asset management business is built on, the reason is quantitative for two reasons. One is that it's succession planning. We don't want to rely on one person, and the sharing of IP. We want to build up junior fund managers. We want to allow them to invest in their own strategy, and it gives us the ability to backtest, which is probably the most important. You can't backtest a gut feel. So an algorithm and a quantitative strategy you can backtest, and you can obviously check the soundness, which is important to us. It's probably key.
Just in terms of your portfolio, just some of the splits amongst the value. I'm trying to guess which of the stocks are value and which of the stocks are momentum here. Where does something like a bulletin fit in? Because my guess would be that it's a resource counter that's deep value at this point.
Well, if you look, it's pure value for us. Paying dividends, not much momentum. And yes, we've taken a bit of a knock if you look at, but we've made about 9%. But over the last couple of months, we took a bit of a knock there, obviously with what was going on in the mines and the resources. But for us, we're pretty comfortable that it's a good value share for us. We will continue to hold it at these levels. And yeah, I think we've got another 260 days I think we've held it for so far. So
well, talking about the split, clearly momentum goes with Mr. Price and ShopRite in your book of the day. And as you say, there's no signal yet to say let go of these stocks. You're going to continue to hold for the foreseeable future.
Well, even with Mr. Price being upgraded and people starting to talk about it, Mr. Price aggressively, I think it's been our best performing stock by multiples.
Besides the individual stocks that you look at, you also develop views about the short-term trading of the market. So where do we stand at the moment with All Share Index?
Well, for us, we still think we're in a bull. We still like the market. We obviously use CFDs to allow for gearing, and we're still fully geared in terms of the market. There's not a raise for concern. There's a raise for us to watch it more closely, of course. We're watching it daily. Sometimes when the bull market's fully intact, you know, we watch it daily, but it's not a level of concern. But as I said, with what's happening in Europe and the noise, it's important for us to gauge the strength. So we'll look at the monthly MSX, and that will obviously depict the trend, and that's bull. And then we look at weekly market strength index to see if there's any buying opportunities, because we believe there are buying opportunities at the moment.
Could the algorithms be taken by surprise when it comes to something like hot money, which completely inflates a situation and then can leave as quickly as it came in? And here again, I'm coming back to the retail stocks that many say, you know, have gone beyond normal valuation, and that a lot of that is foreign money. Yeah. If we had a risk-off trade that was significant and deep, we could see that money flowing out. Would your algorithms pick it up?
It would definitely pick it up. And a lot of that's noise, Bronwyn. I understand where you came from, but again, the numbers say what the numbers say. And we've backtested this thing since 1995, and those situations have happened in the past. And with that and the market timing, there's two variables that allow us to have a deep insight into what's happening. And that allows us, we're not doing micro timing when we start to pick stocks. We look at a macro basis. And yes, we may see some volatility because of this, maybe 5%, but we've earned 35% this year. So we can give up a little bit, not that we like to give up some. But for us, if you take a micro strategy, you start to trade a bit too much, and if you start to listen to the noise, and if you keep trading, it obviously degrades the profitability because it costs money to trade, as everyone knows. So we'll look at a macro level. As we say, we're pretty happy at the moment, and I'm pretty sure it'll pick it up. So
when you talk about macro trade and a micro trade, is micro, you're talking day trading, intraday trading? And what are some of your positions that you hold for? You indicated that with BHP.
1 to 3 years generally, so a medium term. We'll trade no more than 3 stocks every 3 months. 2 months we'll start to look at them. We've run the back test in terms of trading, and the more you trade, it's just the results and the performance goes down. So we make sure when we choose a stock, we pick it right, because we know we're going to hold it for a long time, and we pretty much stick to our conviction. But if all the algorithms say it's time to get rid of it, it's time to get rid of it. Something like Vodacom is looking a bit suspect for us at the moment. No momentum, not much value. So it may be something we swap out over the next 2 to 3 months.
Just in terms of your portfolio, how much traction is there out there from both the institutional player and from retail investors for the quantitative element within a portfolio? Are people open and accepting of the idea generally? I mean, because it sounds as though, I mean, if you look at returns, it's a no-brainer.
It is a no-brainer in terms of, but is the returns driving the huge growth that we're having? I suppose maybe that's a good part of it. A lot of people, it takes a bit of time to understand it. In terms of our distribution strategy, we have 20 salesmen around the country. So it's a lot of sit down with the people and take them through our strategy. We're very transparent, first and foremost. And I think people like that. There's a level of comfort. It's not a difficult strategy to understand, first of all. Yes, the algorithms and stuff, we don't go into that much detail, but the trading science, if you will, is quite simple to understand, and people grasp it and actually like the fact that there's a level of comfort that we give, and I think that's given us a lot of traction.
Warren, just you interview a number of people. What is the take-up for a fund of this nature?
I think, as you've alluded to, Flynn, it's very kind of difficult to explain how you actually go about generating the alpha, because most people don't know what an algorithm is, and they certainly don't understand what the mathematics is behind it.
So the mystery's in the margin. The margin's in the mystery, rather.
I want to be very careful that I don't come across as though I'm trying to sound cleverer than most people, because that's not what I want to do. I want people to understand that we're here to obviously explain it to them, and it's not rocket science. We can obviously explain it, we can sit with them and make them understand, and I think that's a level of comfort and transparency we want to give people, and we're doing that, I think.
Just in terms of the actual correlation of the portfolio with traditional long-only portfolios, I imagine you run both long-only portfolios and hedged or portfolios that short as well. What's the kind of correlation between your long-only portfolio and that of the general market? And then obviously with your hedged portfolios, is it a very different type of correlation? Because when investors look at these things, they say, well, I'm getting this type of exposure through a long-only fund or an ETF. How does this fit into the portfolio from a correlation point of view?
Well, if you talk correlation, I suppose you talk upside and downside capture. And those are the two things I worry about daily. On the upside, for every 1 point the JSE goes up, we capture 116%. So that's quite nice. And we obviously look to improve that to a certain point within risk limits. On the downside, which is more important, we look at about a 92%. So every 1 point, we only capture 92%. So that creates the outperformance, first and foremost. And those are the numbers we work on quite aggressively. And that's the composition of the fund defines those two numbers. We don't go short at the moment because we firmly believe the market is upside and it's a bull market. It wouldn't make sense to be short, but we have the ability if needs be. But you know, at the moment when it gets a bit choppy and there's a lot of volatility, the first port of call would probably be to move to cash. just to de-risk. With CFDs, it allows us to adjust the gearing, so we can be fully geared, half geared, or just pure in cash, and that's pretty much where our risk management sits. The notion to go short at the moment is not even on the table, so that's basically, you could say we are long only funded.